We are ready to wrap up Module 4. We've been talking about the different ways to rank investments. Now, no discussion would be complete without a few definitions and without at least running through one or two examples of how to compute net present value. So let's do that. Definitions. There's something in your reading called depreciation tax shield, and I just have a hunch that might have gone right over the heads of half the readers. So let's define what that is. When you have an income statement, one of the expenses that you subtract is the depreciation expense. Now, this is important because think about it. You pay taxes based on your earnings. So if you've got sales of $1,000 and cost of goods sold of $800, you got $200 of gross profit. If SG&A, selling general and administrative expense, is $100, you've got $100 left. If depreciation expense is $50, then your earnings before taxes is going to be $50. And then if you have a 40% tax rate, $20 comes out for taxes, and your net income is a whopping $30. That's all well and good, but remember, depreciation was $50. What if the depreciation hadn't been there? What if say you rented the building instead of owning it? Then you would have had $100 as your earnings before taxes. Tax rate's 40%. You would have had $40 for your income tax expense. Your earnings would have been $60. But notice how much your taxes changed. Your taxes would have gone up by $20. Guess what? 40% of the depreciation expense is, you guessed it, $40 is going to be, 40% of 50 is going to be 20. So you're going to have a $20 savings because of your depreciation expense. You would have paid $20 more in taxes if depreciation hadn't been there. Which brings us to the moral of the story. If you take your depreciation expense and multiply it by your tax rate, that is your depreciation tax shield. That's how much depreciation expense, which is a non-cash expenditure, is saving you. So, when you hear the expression depreciation tax shield, it's nothing more than depreciation expense times the tax rate. Point number 2, sunk costs. Every time the U.S. Defense Department argues to keep some military system in place, invariably, they say, we've already spent $3 billion on this. Let me tell you something from a finance perspective. If the future cash flows on that project are going to be negative, it doesn't matter what's been spent in the past. That's a sunk cost. It's a cost that doesn't impact our decision whether to say yay or nay to the project. Only the future cash flows do. So, you look at future cash flows, you look at costs that are going to be happening from now into the future. You don't look at historical costs. Those are sunk costs, and they don't affect your decision on the project. Finally, we have been talking a lot about costs, but for projects, it's the incremental costs that matter. In this case, if you've got a new plant, or a new line that's being constructed, you're going to have new receivables, new inventory, and new accounts payable, all of which are referred to as working capital. Don't ever forget to quantify the effect of working capital and the working capital needs as part of the incremental costs. Incremental costs matter when you're doing a project analysis, and one of the most important areas that gets overlooked are the working capital demands. Those are the definitions that we missed. Now, last but not least, let's at least run through one net present value problem. If we've got an investment Now mind you, nothing is free. So we decide that we need to have an apartment building, and we have to spend $150,000 to buy this fixer-upper. So it's $150,000 on day one. Then in the first year we spend another $100,000 to renovate it. So far we're $250,000 in the hole. The next year we make $100,000 of rents, and the following year we make $100,000 of rents, and then the last year we make $100,000 of rents, and we sell the building for $200,000. My cost of funds is 6%. I'm wondering what the net present value of this investment is. Well, we go to the net present value command on Excel. We put in these cash flows. The one cash flow we don't put in is the initial cost. We have to subtract that from our net present value calculation. So we're going to say 4 years of cash flows, get the net present value, and then subtract the initial investment. Let's see how this would look on Excel. We go to the FX button. We go to any particular cell we want to. We know it's going to be NPV, so we double-click NPV. Our cost of funds is 6%. In year one, we've spent $100,000. Now that's going to be a negative sign because we spent it. A negative $100,000. We've renovated the apartment. Now we collect $100,000 the next year. We collect $100,000 the second year. And the third year of positive cash flows, we collect $100,000 and we sell the building for $200,000, which adds up to $300,000. We hit OK. That gives us all the revenues we're making once we basically have moved into the apartment. It does not say what it costs us to buy the apartment building, so we subtract the initial cost. We manually do that. So we take $150,000 that we spent and we subtract. So we take one cell and subtract the other, and lo and behold, it's a positive $166,000 for our 4 years worth of work. $166,000, because it's a positive number, we accept the project. That's how you do net present value calculations of uneven cash flows. We'll give you a little refresher of that next week to just keep everyone in lockstep as to how to do net present value calculations. But for Module 4, that wraps it up for this week. Take care.